Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing, make sure you reach out to a qualified financial advisor. But with that said, let's get into another episode of the Young Investors Podcast. All right, welcome back, everybody. Welcome back, Brandon. You're about to jet off to Japan. It's very exciting. Is this the first time you've been to Japan?
Yeah, I've not been to Japan before. I'm very excited to go. We're going to go skiing. We're going to fly into Tokyo, spend some time there. Then we're going to go skiing at a ski resort not too far away, I think. Then end up going back to Osaka and then back to Tokyo. And then we jet off back to Australia. So it's going to be, I think, a week and a half in Japan. It's going to be cold, but it's going to be good.
Yeah, no, that'll be exciting. Japan's definitely on my list. I think, because I just did South Korea, which is obviously not the same as Japan, but similar to Japan. And some of my friends went over to Japan after and said it was fantastic. So I'll.
Oh, really?
It's definitely on my list. Yeah. I always get like really cinematic shots of Japan on Instagram Reels. I don't know if you get those of like the streets and like the neon signs. So
there's so
always
much.
Makes you jealous.
You can do the cherry blossoms. That's all cinematic. Or you can do like the snow and the mountains. That's cinematic. Or you can have like the grunge kind of neon street vibe, which is its own. I think it's just going to be a very pretty place to go. But no, I am looking forward to it. I need a holiday.
Yeah.
But what are we talking about today? I can't go on holiday yet because we got to do this podcast.
No, exactly right. Today we are talking about investing or gambling or speculating. So I think, especially when you start to take investing a little bit more seriously, one of the first things you'll probably hear is, make sure you know the difference between investing, real investing, and speculating or gambling. And I'm going to use those two interchangeably, using them synonymously, gambling and speculating in this episode. But I thought we would go through first, and I'll just give kind of a quick kind of textbook definition of what investing is and what speculation is, or at least a textbook definition. But then I think more importantly, we're going to go through and demonstrate some kind of behaviors and situations that can tell you whether you're actually investing. Because it's one thing to kind of know the textbook definition, and it's another to actually practice it in your month by month, year by year investing. So that's what we're going to do in today's episode. So let's just get straight into it. So starting off with some kind of definitions. The definitions I grabbed here are actually Benjamin Graham's definitions from The Intelligent Investor. It's a book that's kind of known as the Bible of Value Investing. We spoke a little bit about it actually last episode, I believe. And it was written in 1949. There's been a bunch of kind of revisions made to it over time. And there's a big section in there early on in the book about investing and speculating. So the definition of investing, according to Benjamin Graham, is an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. So there's kind of a couple of key components in there. The first is thorough analysis, right? So having some kind of process for reading financial statements, gaining industry knowledge, assessing the management team, and then calculating the value of the company. So having some kind of process to do thorough analysis. And then the two main goals with investing are the safety of your initial investment. So that's kind of Warren Buffett's classic rule number one of investing: don't lose money. So safety of your initial investment, and then providing an adequate return. So not having this expectation for some crazy 1,000% return. But just looking to make a reasonable return over time.
It's about compounding, right? Yeah, it's about compounding. It's about looking for ways to grow your money, but without a very big risk of you losing it all. Because if you're at equal risk of gaining money as to losing money, then I wouldn't deem that an investment. You've got to find those situations where your money is more likely than not relatively safe. Of course, nothing's ever certain in the stock market, but generally speaking, you've done the research where you believe that your money is more likely than not safe, and then it can get the snowball rolling and the compounding effect, making you a little bit more money. So yeah, I think I think that's very important. I remember reading this. I was listening to the audiobook actually of The Intelligent Investor, and when this definition came up, I was like, bang, bookmark, because it's just so perfectly put that it's not just about making a return. It's about doing your analysis, protecting what you've got, and then from there trying to find situations where you can just add a little bit more. And that's very much the Warren Buffett philosophy. Rule number 1, don't lose money, as you say.
Yep, exactly right. And then for Graham's definition of speculation, he just says anything other than that.
Right.
So anything other than investment is speculation, which is kind of a fairly simple way to think about it. It's important to note he actually doesn't say that. He says actually explicitly that it's completely fine for you to speculate if you want to. He says there is such thing as intelligent speculation. But the most important thing is to not engage in what he calls unintelligent speculation. And he lists a couple of things that kind of describe what that looks like. So that would be speculating when you think you're investing. So if you think you're investing, but in fact you're actually speculating, which is the whole kind of thing we'll get to in this episode, that is unintelligent speculation. Very different from you saying, I'm going to set aside a very small amount of money and I'm going to make a gamble. That's a very different thing from thinking that you're investing and actually you're not really. Speculating seriously instead of as a pastime, so instead of just as kind of a side hobby thing, and then also risking more money than you can afford to lose. So those are types of unintelligent speculation. So he actually doesn't say that you can't speculate or that you shouldn't if you want to, but making sure that investing is its own defined thing and you don't kind of muddy those two things.
And I think like a lot of the best investors also speculate as well. Like I know a lot of really good investors that love like straight up gambling, but they know what they're doing. Like they know that because there are situations in the stock market you can find a small company that the stock could pop 1,000x, like it could just go crazy, but you could lose all your money at the same time. It's a high risk. And some investors, some really good investors still take those gambles, but they know they're gambles. They keep them as a very, very small part of the portfolio so that broadly speaking, in their portfolio, they do have that safety of principle. It's like 95% solid investments and then 5% bets that could go crazy, but also could lose 100%. So it is definitely about knowing, intelligent speculation as opposed to just rocking up at the casino. And I watched the video of the guy in the Vegas casino where they're like, are you sure? You understand that you're betting your entire life savings on red and you may lose everything. Have you seen that? I'm sure you've seen that. Yeah. Oh, I mean, luck was in his favor, I think, that time round. But geez, that is some unintelligent speculation right there.
Yeah. No, for sure. I mean that gets kind of at the crux of what we're going to talk about today, because the big risk is that most people think they're investing when in fact they're actually just speculating, and that's a really, really dangerous place to be, because if you know you're speculating, you're probably just going to put a bit of money that you're willing to lose aside. But if you think you're investing and you're still gambling, you're still speculating, you can end up losing a lot of money that you can't afford to lose. And that's a really dangerous place to be. And most people, it can be very difficult to figure out whether you actually are investing or speculating. So that's what I wanted to talk about. I thought we could go through some kind of, I guess, situation, scenarios, or kind of behaviors that you might experience in the markets that actually give us a really strong indication of whether you've done your thorough analysis and you really understand what you're investing in, or whether maybe in fact you're actually speculating when you think you're investing. Do you want to take us through one first, and then we kind of go back and forth?
One of the situations that I thought up is this: you've bought $5,000 worth of gold because you hear that gold performs better in tough economic periods. Investing or speculating, Hamish? What's your call on that?
Could very well be speculating. Yeah.
Yep, I definitely think that that's speculating. Firstly, the dead giveaway here is is the quote, because you heard. I'm doing something because I heard. That's definitely a giveaway that you're making a decision based off of, something other than that thorough analysis like we were talking about
my uncle told me, my best friend just bought this stock, kind of,
Yeah. Barry says, that kind of stuff, that's all speculating. But, even taking that away, with a commodity like gold, unlike a business, there are no cash flows. So when it comes to, I guess we should talk about this now. When it comes to investing, a lot of the safety of principal and an adequate return comes down to understanding what the business returns for its owners, the cash flows of the business. And then anything else, I don't know, any sort of valuation that's not based on that is speculating, because you're just not as sure about it. So, for example, with gold, there are no cash flows. I mean, the only way you can make money from that investment is by the price rising and you just selling it for more than you bought it. But with gold, price rises and declines are simply not based on cash flows. Whereas with a business, if you are the owner of a business, you know that if there's higher cash flows, then that will create your company is more valuable because you get more money just by owning it. So,
and you know, the main thing that's driving a stock's price up over time is an increasing ability of that company to deliver cash flow to its owners. Whether or not it does it, some companies, retain their cash flows and over time, and some pay a dividend. But regardless of that, what's holding and driving the stock price is its increased ability to actually deliver real cash to your account. And you're right, when it comes to something like gold, you're just hoping someone else pays more for it than you did. So it's a completely different field, and most people, especially value investors, would say that you can only do analysis of price analysis or valuation with cash flows, because you can just compare what you're going to get back to what you're paying, and you can actually do an actual mathematical calculation there.
Yep. So no cash flows. It means that asset is speculative. Same can be said for all the commodities out there, like Bitcoin is another one. It's like we're not trying to create some sort of ruckus or debate around Bitcoin, but just by definition, it is a speculative asset. The only thing you're doing, you're buying it hoping that one day you'll be able to sell it to someone for more. If you buy Pokemon cards, same thing. You buy them hoping that one day you'll be able to sell them for more, but you don't actually know that because there's no underlying cash flows. There's no improvement in the asset. It just sits there. Like Warren Buffett said, gold is just a shiny bit of rock, but if things get tough, you can't eat it. The only thing it can do is sit there. So
and that's not to say that something like Bitcoin will go down. Bitcoin can still deliver. It's been doing incredibly well for people who are holding their portfolio. But it's to say that if you're buying Bitcoin, you can't have that confidence of safety of principle. Like you can't, there's nothing, there's no cash flow basis, there's no cash on the balance sheet, there's no management team, there's no, network of employees and competitive advantage. There's no flaw that when you put your money into a good business, your principal is likely safe. Of course, it's not definitely safe, but there's at least, through your thorough analysis, proof that your principal is likely safe. And you just don't have that with Bitcoin. Not to say that it won't do well in the future.
Yeah. I mean, worst comes to worst with a business, like literally worst comes to worst, it gets shut down, broken up into its pieces, and all the pieces get sold off. All the assets get sold off. In which case there literally is a flaw.
Exactly. Yeah. Exactly.
Yeah. All right, Hamish, take us through it. So, okay, investing, buying $5,000 worth of gold because he hears gold performs better in tough economic periods, that is speculation. What's another scenario?
Okay, my one is a stock that you own drops 10% on an earnings release. So it's quarterly earnings come out, and you wake up in the morning if you're in Australia because it comes overnight, and the stock drops 10%, and you feel really, really worried. Like you get this kind of really, you don't feel good about it. Is that investing or speculation?
I would say because you're feeling so scared about it, you've speculated.
Yeah. And maybe your gut reaction to that is, well, how could you not be worried? How could you own a stock and it's dropped? How could you not be worried? Well, if you own an individual stock, so we're talking specifically about owning individual businesses. So if you own an individual stock, it should have met your thorough analysis, right? So this is a thorough analysis part of the investing definition. So it should be a company that has basically zero chance of having any debt or liquidity concerns for starters. Like it should have pretty much no debt, or it should have far more cash than debt. So that's not an issue. That's not why the stock's gone down. It should have a competitive advantage. It should have an economic moat that likely means the business isn't going away anytime soon. It's a staple business. It has a product service that's unique and highly desired by customers, and it's been highly desired by customers probably for decades. The industry is a very stable industry. The management team is honest, intelligent, and they've had a history of working through short-term problems. And you've bought the stock previously at a price that's far below intrinsic value. So your initial investment is likely still safe despite the drop. So if you've done your thorough analysis, if all of those things are true, then the most likely reason that the business has, or the stock has seen its stock drop, is because they missed some kind of short-term earnings expectation, which happens, right? So Wall Street builds up these expectations quarterly, annually of what earnings are going to look like, and the stock rises to meet those expectations. And if they miss them, then sometimes the stock goes down. But that's completely meaningless to you as a long-term investor. There's obviously exceptions to this, but generally speaking, this is pretty true. If you've done your analysis and it is an incredible business and you paid a good price, you'll still see stocks fall 5, 10, 15% on earnings. But it shouldn't worry you, because you know that it's probably a result of just the short-term, voting machine of the market, deciding where the stock should be, marginally throughout the year, which is completely meaningless to you if you plan on holding it for, 10 years.
Yeah. I think this takes a little bit of experience to get more comfortable with, because I think early on, even if you're very sure about a stock, there is still that feeling of the unknown just because you're a bit inexperienced. But yeah, definitely. Like I can honestly tell you now that every single company that I hold in my portfolio, if I woke up tomorrow and I saw that the stock had gone down 30-40%, I wouldn't feel bad. I would feel excited. I'd feel really excited. And I think it takes a while to get there, but
yeah.
And that's because I think earlier on in when I first started investing, there were stocks in there that I wasn't, people are making good points. I think this is right, but I wasn't 100% sure. Whereas now I'm really comfortable that I understand the businesses in my portfolio. So yeah, that's I think that's a big factor. But yes, definitely if a stock goes down and you feel very bad about it or unsure, I think that's a good sign that you haven't made an investment.
Yeah. And it also possibly speaks to the type of company as well, because there are businesses that people will want to invest in, and the nature of the business and its future is just volatile. And that's also a place you probably don't want to be. So, within a quarter or 2 quarters, things can go from being great to being absolutely terrible. And that's not a place you want to be. Like there was a company, Australian company called Appen. They're an AI company, and they've had big clients in the US tech giants, Google and Meta platforms for a very long time. And within 1 quarter, they lost Google, which was, I think, I don't know the specific numbers, but it was like 30% of their revenue or something. They lost the contract. So within the space of a quarter, the business did fundamentally change. And that's also just a place you don't want to be. You don't want to be in a business where you can wake up, the quarterly results are out, and the business is completely different from what it was when you invested. It's a much better place to be in companies that have just been doing the same thing day in, day out for 3 decades. They have a solid customer base, and you know that quarter by quarter, nothing really that crazy can happen.
Yeah. Yeah, very good. All right, shall we move on to this next scenario?
Yep.
All right. You buy 3 tech stocks in whenever it was, late 2020, and they all go up over 20% in the next 12 months. You figure the key is to just buy tech stocks, so you buy another 3 companies in the same industries. What do you reckon?
Yeah, that's definitely speculation.
That is definitely speculation.
That is not investing. No.
And this is actually something that that is very, very common. It's called the overconfidence effect. So a lot of investors, statistically, okay, you're a new investor, you buy a stock. Statistically, there's a 50% chance in the next little while that the company's going to go up. There's a 50% chance it's going to go down. Half the investors out there, they'll buy one stock and it'll go up. Half the investors will buy a stock and it'll go down. The 50% where it goes down, they think, oh man, I don't know how to do this. I don't want to do investing. They usually just never invest again. But the other 50% where they've invested in a stock and somehow it's gone up, they go, oh, I'm good at this.
Yeah, I'm a genius.
I'm great. I'm so good. I'm Warren Buffett, baby. Look, my stock at the top of the bell curve, my stock just went up 30, 40%. That's better than Warren Buffett. Yeah. What is the average? 20% per year. Yeah. He doesn't know
Warren
anything.
Who?
Yeah, exactly. So, and that's a real thing. It's the overconfidence effect, where really you think you know more than you do. And any activity around your overconfidence is generally speculative because your brain is tricking you to believe that you know what you're doing when you don't. And thus, when you do something, chances are you actually don't quite understand the full story. So this is a behavioral, bias. It's a bias that everybody feels. You go out and you play a video game and you go, play a sport and you just happen to do pretty well. You're like, oh yeah, I'm good at this. And no, you're probably just lucky. But yeah, this is very dangerous when it comes to investing because you do end up just buying stuff when you don't really know what you're doing. So you're not ensuring that you haven't done your thorough analysis. You're not assuring that you've got the safety of principle. And who knows if you get an adequate return? You don't know. You don't know.
Yeah. And there's a really simple way to, if you find out, okay, I maybe I don't know enough about this or I don't want to just be picking individual stocks, but maybe I want to have some of them. There's a way around it, and you can just buy an index fund and, participate in the market. And maybe you want to do both. You can do a little bit of both if you want. You can, do 90% index funds and play around with 10% if you want. Or you could, be more individual stocks. You can decide how much you want to be, how you want to be investing. So I think that's important too.
Yeah, nice. Should we do one more?
Yeah. Have we got one more?
Yep. Yeah, I got one more. You found a great business that has been growing quickly and generating a lot of cash, but when you value the company, you note that it's currently 50% overvalued. But analysts are saying that the stock will easily grow into its valuation over the next few years. So you decide to buy it. Yeah.
But the analyst said, but that guy on CNBC. You've done the
research. You have done the research. You think it's a great company. It's got a moat. It's been growing quickly. The management team is good. Obviously, it's doing really, really well. But when you come to the valuation, it is 50% overvalued. But it's just the future. The next couple of years have just been priced in. They've just been priced in. So the company, it's going to get there, but it just needs a little bit of time. Speculation or investment?
I'm glad you included this one. Definitely speculation. And this is one I think a lot of people fall into. It's a very easy trap to fall into. So I'm glad you included this one. Yeah, this one's definitely speculation.
Yeah. So what? I'll break down why. While the first part of the example is in line with an investment, doing the analysis on a cash-producing asset and valuing the shares, if you buy the stock in this instance, you are being speculative. Your analysis was grounded in reality, but your decision was not. You aren't waiting for a business to be repriced up to its intrinsic value. What you're doing is you are speculating that the company will be able to execute exceptionally and that it will magically turn your high buy price into an even higher price that you can sell at down the track. Your investment isn't grounded in the reality of the current cash flows of the business, and thus you're playing a guessing game. So the company may grow into its valuation. That can and does happen sometimes, but the point is the decision that you made was one of speculation rather than an investment. You're not confident in it. You're hoping, and as I say, that can happen. We've seen plenty of overpriced tech stocks actually grow into their valuation somehow. But yeah.
Yeah.
It's still speculation.
Yeah. This is a tricky one, and I think this speaks again to there's a lot of behavioral finance involved in this one as well, because most of the companies that you analyze, you'll find it's a great business. Most of them will be fully priced or overvalued most of the time. That's just how it works, because markets, if the business is doing well, markets will be usually overestimating, overhyping their short-term performance. So the stock will reflect that. So you just have to kind of get it into your head that, it's a great business, put it on the list, and maybe one day I'll be able to own it when there's some kind of short-term turmoil or something bad happens in the business that doesn't affect the long term of the company. That's just kind of unfortunately the nature of investing. Sometimes you might have to wait years before you get to invest in a great business that you've admired for a very long time. But if you can wait and you do get it at that low price, and then it does end up performing exceptionally on top of that, you will do even better than you expected. And your principal will be safe because you didn't bank on the exceptional performance. And I think that's the key with this one.
Yeah, very good. All right.
Well, hopefully you guys enjoyed this episode, going through some scenarios, some situations regarding investing and gambling and speculating in the stock market. As always, we appreciate your feedback, whether it's natively in Spotify. You can leave your feedback or questions if you have any, just by scrolling up on the Spotify episode, or head over to the YouTube version of the podcast. We've been breaking up the podcast on the YouTube version and splitting it into clips for each kind of story as well. So go check that out if you haven't subscribed over there already. Thanks, Brandon, for joining me as always.
All good, mate.
And we'll be back in the next episode. So have a great rest of your week, guys, and we'll see you later. See you later, guys.
I'm off to Japan. Goodbye.
Bye.